Every May, one document decides what every Australian pays in tax for the next 12 months.
It controls hospital funding, defence spending, welfare payments and your pay packet.
Most Australians have never read a single line of it. Today we are going to fix that. This is the federal budget, explained simply.
Let us start with why this confuses most people.
The Treasurer reads a speech full of acronyms, forecasts, and percentage points. News headlines focus on winners and losers without explaining the mechanics.
The result is most Australians have no idea how decisions made in Canberra change their actual take-home pay.
Here is the real definition.
The federal budget is the government's annual financial plan, delivered by the Treasurer. It has two halves. Revenue, which is money coming in, and expenditure, which is money going out.
Revenue minus expenditure equals either a surplus or a deficit. That single number defines the entire year of national policy.
Let us look at the revenue side first. Where does the money actually come from?
Personal income tax is the biggest source. Roughly 47 cents of every revenue dollar. Company tax adds another 21 cents.
Then GST, fuel and tobacco excise, and capital gains tax make up most of the rest. Your pay packet is the single biggest contributor to the federal budget.
Now the spending side. Where does the money go?
Social security and welfare is the largest category. Pensions, job seeker, family payments. Then health, Medicare, public hospitals, the PBS.
After that comes defence, education, infrastructure, and interest on government debt. Health and welfare together account for over half of all federal spending.
So what is a surplus versus a deficit?
Surplus means revenue is greater than spending. The government has money left to pay down debt. Deficit means spending is greater than revenue, and the government borrows the difference.
Australia ran deficits through most of the 2020s. The 2026 budget projects a return to surplus by 2028, partly through major tax reform.
Who actually writes the budget?
Treasury officials prepare forecasts on growth, inflation, and tax receipts months in advance. The Treasurer and Cabinet then make the political choices about which programs to fund.
The Reserve Bank, business groups and unions all lobby in the months leading up to budget night. It is a long process of forecasting and negotiation.
3 ways the budget directly changes your pay.
1. Tax brackets and offsets. Moving thresholds or rates changes the tax taken from your pay every fortnight. 2. Deductions and concessions. New rules on negative gearing, super, or work expenses change your annual refund.
3. Welfare and rebates. Family tax benefits, childcare subsidies, and the private health rebate are all set in the budget.
Let us look at the actual 2026 budget headlines.
A new $250 working Australians tax offset from 2027 to 28 for over 13 million workers. A new $1,000 instant tax deduction for work-related expenses from 2026 to 27.
And the 50% capital gains tax discount is being replaced with an inflation-indexed system from July 1, 2027. Each one directly affects how much tax you pay.
3 dates drive the entire Australian tax calendar.
Budget night, the second Tuesday of May, when the Treasurer delivers the speech at 7:30 p.m. Australian Eastern Standard Time. July 1st, when most new tax rules start. June 30th, the end of the financial year.
If you make tax-related decisions, these 3 dates should be in your calendar every year.
Here is the link between the budget and your mortgage.
The government does not set interest rates. The Reserve Bank of Australia does. But a big spending budget can add to inflation, which forces the RBA to keep rates higher for longer.
A tight budget that reduces spending gives the RBA room to cut rates. Budgets and interest rates are connected, even if not directly.
5 myths the headlines get wrong.
1. A deficit always means failure. Deficits during a recession are often deliberate stimulus. 2. Tax cuts always help you. Bracket changes can disproportionately favor high earners.
3. Announced changes are guaranteed. Many reforms require legislation that may not pass. The 2026 reforms still need Parliament approval. Cut through these myths and the real impact becomes clear.
Let us bring it together.
You understand the budget is just revenue minus expenditure. You know where the money comes from, where it goes, and the 3 ways it changes your pay.
And you know the key 2026 reforms rolling out from July 1st, 2026. You now understand the federal budget better than most journalists.
Thanks for watching. This is general information only, not personal financial advice. See you there.